We see
Morning.
how Asian markets react to many things, but including how the U.S. markets reacted on Friday on that very, very hot inflation report.
Yeah.
What is key next? I know that you're in the camp that says 2 rate hikes from the Fed. The Fed meets we'll get the decision on Wednesday. Do you still hold that view? And is that a risk to bond investors and maybe a risk that points to a higher dollar?
Yeah, I think it's easy to continue with the central bank divergence theme. It's been one of the biggest themes for this year. It will continue to be one of the biggest themes for next year, and people will actively continue to position portfolios in FX for that situation. Whether we continue to see the spread differentials in 2s and 5-year differentials between US Treasuries and respective other markets, I think that's been a major driver. I mean, that's what we're going to need to see. We're going to need to see US Treasuries sell off more aggressively than other markets to continue to boost the US dollar. But what I like about this is, for the first time in a while, is we're going into 2022 without the dollar being a significant consensus trade. I know most strategists are generally sort of saying the dollar's still very bullish. But if you look at the year-end forecast for euro dollar, it's the medium number is about 117, which is obviously higher than where we are on forwards at the moment. So I think that's a big positive for the US dollar. But we will need to see yield differentials continue in that situation. I don't know. I mean, look, for me, I stay in the camp that we go for 2. I know that some people are even calling for more than 4 now for next year. But the issue with 2 gives you a little bit of a buffer if we are to see a correction in risk, if we are to see a drawdown in financial conditions, which I think will happen at some stage. Then obviously rate hikes will be priced out, and therefore you have some element of tactical positioning in that situation. So I think there's obviously, you need to be open-minded. We could see more than 3. But, if we do see the drawdown, if we are going to see markets correct, then of course, a lot of that rate hikes will be priced out of markets, and it just gives you that buffer there.
So, Chris, how much does it depend on what other central banks do? In other words, let's say whether the Fed hikes 2, 3, or 4 next year, we won't know. But if they signal that they're on the path to higher rates, that's going to be enough maybe to convince people of what their intent is. So,
yeah.
What about divergence then? Is this whole kind of move into dollar accentuated if other central banks lag? Is it mitigated a bit if they don't?
Yeah, I mean, it's a fantastic question, because I say the divergence theme is still very much one of the big macro plays, especially in FX markets. As we look at that, look very closely at what's priced in rates. We've also got to look at the starting point of what we're going in for. We've got an ECB meeting this week where, we're sort of toying with the idea with, will we get a complete closure? Will we see a hard closure of the asset purchase program, the APP program, by the end of 2022, which opens the door not just for rate hikes in 23, but also potentially even earlier than that time. Excuse me. Excuse me. But then you've got the RBA. The market is discounting a similar path as the Federal Reserve, but the RBA refused to sort of go to the open-minded stance. They're saying that we're still looking for rate hikes in 23 and beyond. And, obviously a lot depends on wage pressures there. But I think the market is just like, these guys need to change their tune. At some stage, we're going to see them change their tune, and they're going to keep up pace with the Federal Reserve. If they're hell bent on that, because we're not seeing the wage pressures, then you're going to see the Aussie under pressure and the dollar rally. A lot will depend on what happens in China as well. So I think you've got to look at where we are as a starting point, and look into the future, into 2023. It's very easy to say that you like the dollar. It's easy to like the dollar. It's easy to love the dollar, because you've got an element of cyclicality. You've also got an element of potential safe haven play if we do see drawdown as well. But I think the relative settings is really important there.
So it's easy to like the dollar, but I spoke to a number of people last week who see very good value in EM at the moment, particularly Indonesia. So how does a strong dollar play into that narrative?
Well, I don't really focus on EM. It's more sort of on the G10 and DM side of things. But obviously, a lot has happened in terms of the heavy lifting from EM already, and we're going to see more of that this week. There's a significant amount of EM countries which are coming out, and some of them will be doing rate hikes. But I think if we are going to move into a restrictive world and a more normal setting from policies, then of course it really depends on real rates for me. If we are going to see the US real rate move up sharply, and if we are going to see an element of steepening, don't sit in the camp that we don't want to be looking. We really don't want to be putting steepeners on at the moment. But I think we could see an element of flattening continue to play out. But if real rates in the US are to move up to say negative 50 basis points, which is a decent move in this environment, then of course EM is still going to be very much underweight. It's going to be a tough time to be in the EM, and it's not, you still continue to want to be in US dollars in that situation. So I think for me, let's have a look at what happens in the yield curve. Let's have a look at what real rates, and we can make a better play around EM for going into 2022.
You mentioned the RBA there. Of course, we're not going to hear from them again until February now. The market rather forced the RBA's abandonment of its bond buying program. There's a huge divergence between when the Reserve Bank says it's going to raise interest rates and when the market thinks it's going to do it. Are we going to see the market force the RBA's hand again?
I think if anyone's going to force anyone into anything, it's probably going to be the market forcing the Fed to pivot. We've already seen the Fed pivoting pretty hardly, and that will probably be the case. What I think is interesting here in Australia is that we've just had, the markets have just been hell-bent in their belief about what's going to happen for so long. It's not just been a new phenomenon. We've had, aggressive rate hikes being priced into the curve for weeks now, if not months, and people can listen to what Philip Lowe and the board have got to say, but they've made their mind up that we are going to see inflationary pressures, and Philip Lowe can come out and say that we need to see 3% in wages before we start as a starting point, but they are hell-bent on the belief that we are going to see lift off this year, and it's going to be keeping pace with the Federal Reserve. And I think part of the nuance that you have seen in the RBA's language is that they want to keep pace with the Fed. So I think as long as the Fed are going on this road, then the market is very much in the tune that the RBA will follow suit.